Good afternoon, everyone, and welcome to Plain Saver. My name's Ashraf, and I'm part of the business development team. And alongside me today, I have
James Jordan. I am the lending manager here at Plain Saver. Good afternoon, everyone.
Brilliant. So today, we want to talk about loans 101. So alongside us today, we have James, the lending manager, and we want to go through and cover the basics of a loan, how to apply for a loan, what a loan means, and who approves them, the people behind it. Brilliant. So to start off with, James, I've got some questions. I want to fire them off to you and I want to see your thoughts. I think it's really interesting.
Fire away whenever you're ready.
Brilliant. So not every loan is the same, right? And can you name some of the loans that there are and the different types of loans that people can apply for?
Yeah, most certainly. And I think you made a very great point to start off with. There's a common misconception when it comes to loans, and everyone thinks that all loans are the same, but they're actually not. And you can get various different types of loan. First loan that I can think of, debt consolidation. That is one. It's a type of a personal loan. I'll explain what a personal loan is next, but debt consolidation I think is very key with cost of living going on right now. And a debt consolidation loan is where lenders like ourselves, other credit unions, high street banks, they'll look to give you a loan to go towards clearing off any existing credit cards, other loans that you've got outstanding, catalogue accounts where you feel like you're paying quite a high amount on a monthly basis. Not only that, not only are the repayments high, the interest that you're paying on those finances that you've got may be crippling you a little bit. So the whole purpose of a debt consolidation loan is to clear off as many finances as you've got, and as you can, drop them down to one monthly affordable repayment for you.
Oh, okay. So a question, I want to break that down a little bit. I think that's really useful. So in terms of a debt consolidation, if I have different debts with different credit cards or buy now, pay later plans, I'll be able to clear them off with a debt consolidation.
Yep, you will absolutely be able to clear them off with a debt consolidation. And with our process, we'll have a conversation about you, find out a bit more about yourself, your circumstances, how the build-up has happened. And one thing that we would look to do is we'll obviously go through those finances that you look to clear, and we would actually make the payments directly to your creditors. So it's one less hassle for you to worry about. All you'll need to do is provide us with the information, and then once your loan's approved, we'll take everything out of your care for them.
Nice. So pretty much an automated system. I mean, when we try and help and make it easier for people to pay off their debts, I like that.
Absolutely. And I suppose the biggest difference between us and your other financial institutions, your other high street banks is, yes, it is automated, but it's also human touch. So again, me and the rest of the team will pick up the phone, drop you an email, try and speak to you on the phone if we can. If not, we'll converse with you via email, try and build a picture. And the main thing is we're here to help, and we want to help you with your finances, clear off as many of those finances as we can.
Brilliant. I think that's really nice, actually. So moving forward on from that, you touched on briefly personal loans.
Yes.
What other personal loans could I get? Or could someone get at Plain Saver?
Very good question again. So other personal loans, like I said, debt consolidation is one big type of personal loan, but there are various other personal types, and they also are classified as unsecured lending, but they could be for a range of purposes. So if you're looking to go on holiday, I mean, school holidays are coming around the corner next week, or it could be as early as tomorrow. So you could be looking to take your family away. Kids, they deserve a break after a long academic year. You could take a loan out for a holiday. Summer, we're slap bang in the middle of summer, great weather here today. You might be sitting at home thinking, you know what, I think I want to improve my garden. Apply for a loan, home improvements. Again, you can look to take out a loan for buying a car, buying a vehicle. You've been driving your current car for a few years, and you want to treat yourself. You've just driven past, say, I don't know, Mercedes or an Audi dealership, and you've just seen a car that floats your boat. But then you look at the price range. Is it within your budget? It might be. Apply with us, take out a loan. We can give you a loan to help you for that purpose. So there are many purposes and many types of personal loans, but holidays, home improvements, it could be to clear overdraft, it could be to buy appliances, just try and help you out in any way, shape or form.
So touching on to the point of car loans, for example, and the personal loans, is there a limit? Is there a maximum? How does that work?
So there is no limit. So with Plain Saver, the maximum value you can apply for a loan for is £25,000. So regardless of whatever purpose that you apply for, you can apply for a loan for £25,000 maximum, and the minimum is £500. Now, there's one key difference that I want to mention when we talk about car loans. So you can buy for vehicle purchases as a personal loan, but we also do car loans separately, and that could fall under a slightly different lending umbrella, if you will, and that is when you can go to another lender, such as us, you can go to a bank, or you can go directly through a dealership and you can get out vehicle finance. So those terms are usually either called hire purchase, so HP, that seems to be a term that gets thrown out quite a lot.
Indeed,
so under that umbrella, that's when you can go directly through the dealership. They'll give you obviously finance, you can borrow the vehicle from them, and the agreement can vary depending on which dealership or which institution that you go for, but the whole concept stays the same. You borrow money from them to go towards purchasing a vehicle, but you make repayments to them on a monthly basis and obviously at an interest rate. And then I know with some institutions you can fall under what is called a balloon payment towards the end of the agreement that you have. So that's like an early payment to settle it early, and then you'll own the vehicle out.
Right, so moving on from this, quite nicely actually, and it's an interesting topic to speak about. So is it just individuals that can apply for personal loans? Can a business apply for a personal loan, or is there something for businesses to be able to apply for?
And that is another very good question, and to answer that shortly, yes. We do also do business loans, and that is also another loan type that is available in the market. So businesses, they can also go to companies such as credit unions, banks, other financial institutions, payday lenders if they want to do so, and they can also apply for loans, and those funds that they get, that they borrow, will go towards any business needs and business expenses that they may have.
Right, so there is sort of this vast flexibility and variation of products that Plain Saver does offer.
Exactly.
So from both an individual and a business side.
Standpoint, yeah.
And so an interesting thing which we speak about at the moment is student loans. Can you explain a bit more about student loans? Is it similar to a personal loan? How do they work?
They are somewhat similar to a personal loan. Now, I think the giveaway is in the title, student loan. Student loans are usually typically for those students that are going towards university. So I know there could be some people watching us right now where they've got kids at that age that are looking to go to university, or they could be quite ready or preparing themselves to go to university in September. So that's when the academic year starts. So they're more likely will be looking towards student loans, looking at those loans from UCAS and from other institutions to go towards any costs associated towards university. It could be buying a new laptop, could be buying tuition, covering for their course fees, textbooks, materials, anything that helps them towards university. That's what a student loan is typically for, provided by student finance. And again, the interest rate on that is typically next to nothing or very low. And obviously once they've graduated from university, then they would be paying towards that every month through their salary, directly from their salary, so they don't have to worry about that. But obviously, I believe the term is after 30 years, if they haven't paid back their student finance in its entirety, then the government will just wipe that off clean.
Brilliant, and that's something that government offers, not something that Plain Saver offers.
Yeah, that is a key distinction to make. Plain Saver doesn't offer student loans. That is something that the government will do alongside student finance and then UCAS. But what I would probably say, and this point is probably more directed to the demographic of our membership that have children at that age going towards university, I'd probably say from personal experience after going through that process, it is something that's very handy. But what I'd probably say is what's even more important is speaking to your children about the benefits of budgeting, especially when it comes to student loans, because I've seen it where people get the student loans and they think it's great, they're rolling in money in, they spend it sporadically, but in actual fact, a lot of it is to go towards rent, bills, groceries. Like, they should be the necessities that you budget for, And then afterwards, if you've got any disposable left, then you can start spending it on little things to treat yourself and stuff that you want and desire. So that would be probably my advice there.
Nice. So almost an educational piece to people to understand what student loans is. And moving and carrying on with the education piece, I think it's really important for people to be able to understand some of the key terms to do with loans, because sometimes we can look at adverts, flyers, and people aren't exactly sure of what APR means or what representative APR means or interest and technically how that works. So can we sort of go through each one? I can name the first one off and then give me a definition and example if that works for you.
That works perfectly fine. And I think 3 of those terms there that you mentioned are great. And again, another common misconception between 2 of them, interest and APR, can get confused quite easily by many people. The first one I would say is interest. Now, interest in its simplest form is the cost that consumers would pay on borrowing finance. Now, the difference between interest and APR is, they're very similar. However, APR is traditionally higher than interest because APR, which stands for annual percentage rate, it includes interest, but the reason why APR is higher than interest, it includes any additional costs or any hidden fees that go alongside interest. Whereas interest is just a standalone cost that you pay on result of borrowing money from any financial institution, whereas APR covers any additional costs or hidden fees that results from you borrowing money.
That's really interesting. So a question for that actually, and I want to clarify it for myself and everyone watching. Interest is the cost of the loan that you'd like to take, and the APR adds on all the additional admin charges, fees, processing, etc.
Exactly.
So should they be looking at the APR or should they be looking at the loan interest rate?
I'll be perfectly honest, my recommendation would be looking at the APR. Because like I said, that covers all the costs. Interest only gives you the base rate, whereas APR gives you the whole financial cost of what you're going to be paying, not just the initial principal value of what you're borrowing. That will include obviously the interest that you're going to pay over the duration of the loan, and then before you know it, that will obviously tell you what your total repayable value is and covers the cost that involves in that. So my recommendation, consider APR more than interest.
Right, that's really useful actually. So sort of to say it in numbers terms, if I had a 8% loan and the APR on there was 15%, compared to if I had an 11% loan but the APR was 12%, I would go for the 12%.
You would go for the 12%.
Right, because it combines the 2.
Exactly. And again, that's another way for you to look at your finances in a bit more scrutiny, because a lot of institutions obviously tell you about your interest, but they may not necessarily tell you about the APR, but if they do tell you about it, it's in the small print in the terms and conditions. So again, it sounds like a cliche, but what I would say is always make sure you read the fine details, make sure you're fully aware of what your APR is being charged. So then when you're coming to crunch your numbers, looking at your APRs and looking at your finances, you're thinking, okay, to segue back to a debt consolidation loan, if I want to clear certain finances, I can start to rank them. Which ones are the higher APRs, which one are the most crippling ones? I'll get rid of those ones first and get rid of those finances.
Really like that, nice and clear. So then, what is representative APR?
That's another good question. Now, representative APR, what I would say to that is, a lot of people, again, there's a lot of misconceptions when it comes to a lot of loan terms. It can be very ambiguous, but I can see why, but this is the purpose of today, to clear up any ambiguity. So with a representative APR, that is the standard rate that most or all institutions would give their lending. Now, a lot of institutions, they'll give you a representative range of what they would offer, but the representative APR is the average rate that they would offer loans to. But that doesn't necessarily mean you're going to get that rate if you were to apply with said institution. Now, a company could give you a representative rate of say 12%, but you could apply for a loan with that institution. Now, depending on a certain range of factors, you can get a rate of 8%. Another person could apply with that same institution and then they could get a rate at 14%. But the representative rate is what the company, they've crunched their numbers, they've done their research, they've done the data. That is the rate that they can offer as a representative to give people an idea of, one, the APR they could be paying, two, repayment amount as well, and give them a little bit of an indication in the form of a repayment calculator of what it looks like a monthly repayment would be on a monthly basis, as well as interest, and how it's also obviously going to work. So typically, if you see a company offering you a representative APR, they've crunched the numbers, they think, say 51% of people that apply for them, that is the rate they would get
on the application.
Exactly.
Right. So we've built the foundations. We know the different types of loans. We also know some of the key words, some of the sort of jargon that people use. Let's move on to the application process. I think it's really interesting to see how it works, how people can apply, and the steps which PlaneSaver takes, or which a normal loan provider would take to see whether you would get accepted or not. Can you walk us through the typical process?
Oh yeah, absolutely. Now, I imagine with this question, the way I'm probably going to answer it will sound very biased, because obviously I'll talk a lot about the application process here at PlaneSaver, but I'll try and blend it to talk about an application process generally, to try and cover the basis of what most, if not all, institutions would or should follow. Now, obviously, a lot of applications nowadays, because of technology, it's now online. It's no longer coming in doing a paper application, it's all done online. So you would go onto our website, or most websites for an institution. If you've got an online account, you'd have to log into that online account, and then you'll be able to go on to submit a loan application. Or in some institution cases, you can just go directly onto the website, click apply for a loan, and then you'll start to fill in your details.
So here at PlaneSaver, if they are a member, they'd be able to go into the member dashboard and apply for a loan. If they are not a member, they would have to become a member first to then apply for a loan.
Correct. So that is something that we've always been big on. When you're applying for a loan with us, not only will you be applying for a loan and repaying for it every month, you'll also have a savings account, which is also a requirement to save while you're repaying a loan, but you would need to open an account, become a member first before you will be eligible to apply for a loan with us.
Right, that's quite handy. So I can make my repayments but also have some savings alongside. I'm guessing, can I access those savings throughout the term?
You can't access the savings throughout the term. The savings would be locked. So the minimum amount you can put into your savings while you're repaying the loan is £25 a month. And the savings would be locked. We want to try and build financial wealth, financial resiliency, so that by the time your loan is cleared, you'll have a nice healthy balance there for you to have access to, and then you can do with that money as you see fit. You can continue to save, build it up. You can withdraw some of it as well for a rainy day fund if you wanted to.
Can I repay the loan with it?
You can repay the loan with it. So if your savings balance is higher than your loan balance, all you'll need to do, give a call, speak to one of our lovely team members and make that request, and we'll be able to use your savings to clear your loan for you. Or again, you could send us an email, or again, if you log in through the app, connect through us through direct message via the app. We'll be happy to help you with that.
All right, nice. Okay, so the process, we sort of sidetracked from myself. So the process is you'd apply for a loan online.
Yes.
Then what happens?
So again, you'll go through the application, takes roughly about 5 minutes to do. It's
Okay.
nice, a quick, easy, simple process. And like most institutions, we'll ask you for the same information: name, date of birth, address history for at least up to 3 years. We'll ask for employment details as well, how long you've been in your current role. And then we'll ask you for the purpose of the loan, how much you want to apply for, and the term that you want to apply for. So it could be over 1 year, it could be over 5 years, 8 years, 6 years, whatever you want. There's a whole range of options on there. And the last detail I probably want to mention on the loan application, which is probably right at the end, before the declaration, is it will ask you if you are happy for us to conduct a credit check on your profile. Because obviously due to our regulations and because of our responsibility to the ethical lenders, we have to conduct full hard credit searches on every single member that does a loan application. So we do ask for your permission to do that. By making sure that you're happy to do that, then
Right, that's quite interesting. So we just spoke about the credit file and sort of a search, soft
Yeah.
search or a hard search,
Yeah.
right? Is that the two?
Yes.
Okay.
So there's two different types of credit searches that get done by most institutions: soft search or a hard search. Now, there's a key difference between the two, which I kind of give away the title. Soft search means we get to see your credit profile, but the only difference between that and a hard search is the soft search doesn't leave a mark to say, the search has been done on your credit profile. Whereas a hard search will say, so-and-so has done a search on your profile on this date, and reason would be for unsecured personal lending or vehicle finance, whatever it may be.
So then, the question, the credit file, what are the good things? What are the not so good things? What do you look at on the credit file and think, right, this is someone that we can lend to and this is someone that we can't lend to?
Yeah, so, and again, that's a very good question. And I think one thing that I'll probably touch upon a little bit later, but I think it's probably wise to bring it up now, is with credit profile. Again, that is something that all institutions will do, and they'll take that into consideration.
Yeah.
Because when it comes to lending, and whether we approve or decline loans, it all depends on risk and how risky it is, or how less risky or more risky we feel it is to lend money to individuals to borrow. So going back to the credit profile, if your credit profile is obviously in good condition, you've got a very good payment history, you can see a good payment history, good employment history as well, then obviously the risk of lending is obviously very, very small, and you're more likely to get approved. But obviously, if we look at your credit profile and there's a few missed payments, there could be a few defaults, or there could be some active county court judgments, what we like to call a few negative indicators, then obviously for us that poses a high risk when it comes to lending. So they're the sort of visions that we'll see when we're looking at the credit report.
Okay, so if you get declined, then is that it? Can they reapply? What needs to be different? Explain that process for me.
So for that process, now there's a range of reasons and factors why we can decline. And again, one thing I would probably say to everyone in attendance actually, a lot of people tend to think once they've been declined, the reason is because of their credit profile. Now, in some cases that is the case. We may have seen a credit profile and it's not been in the best condition. So again, like I mentioned before, that means for us, we feel it'll be too risky to lend. So we'll decline. So if you have been declined, our process is you'd have to wait 90 days before you can reapply again.
Okay.
After 90 days, hopefully by that point, once I've done some work and made some changes to my finances and my profile, if I can, then I might be a bit more lucky and actually get approved this time, and it'll be a bit more of a positive outcome.
Right, okay, so with it being risk, both positive and sort of negative indicators, how does it determine your loan rate? How are loan rates calculated? Is there a way that they're calculated beforehand? Does it depend on your credit score? How is that rate calculated that you are offered as a member?
So that is another good question. It varies,
right,
depending on institutions, but the general concept is when it comes to loan rates, they can either be determined through market rates, could be determined in line with interest rates, which obviously can pose very much pros and cons. So obviously if interest rate falls, then obviously you can end up getting a loan at a very favourable rate. Then obviously if interest rates go up, then again, if you look to borrow, you could be looking at getting it at a high rate. You could also be looking at risk-based factors, depending on risk-based factors and how you're going to weigh up the risk. So it could be based on an internal risk criteria, and that would be determined by institutions. So they could look at risk-based portfolios, and depending on what their risk management is, how they want to look at it and how they want to criteria their assessments. That's usually how, between most institutions, how rates are determined.
Okay, that's quite interesting. So each of the different institutions can vary in their interest rates and depending both internally and outside of what's happening in the current environment.
Exactly. So it can be determined by internal and external factors, But I'd like to say, I'd like to think, and especially I can say that for here, we would like to feel like the rates that we offer are very attractive according to the market, and obviously they're open to change, because as much as we want to approve loans, I think the key thing is we want to approve loans at a rate that obviously is competitive, but at the end of the day, rates that are most affordable and helpful to the members.
Okay, so Plain Saver as a credit union is regulated by the FCA, the
Yes.
Financial Conduct Authority. Very similar to banks, building societies, it's heavily controlled and regulated, right? With loans, we are also part of the FSCS scheme, compensation scheme.
Yeah.
Why does someone need to make sure whoever they apply a loan with, whether it is Plain Saver or not, they are covered by the FSCS? What is the FSCS?
So the FSCS is a financial system. Now, I think at the end of the day, we're all humans. Now, errors can occur. Some can be preventable, some aren't preventable. But it doesn't necessarily mean that no one's perfect. Institutions can still make mistakes. But the beauty of the compensation scheme is if an institution does make a mistake, then you are compensated, or you'll be protected by this scheme. So if an institution if they're found to be made a mistake, or you feel like they've made a mistake with your loan, then if you were to go directly to the compensation scheme, 100% you'd be entitled to your claim. It's also in the event where insurance companies, they can't pay out. So where insurance company can't pay out and something was to happen to your loan, if you go straight to the compensation scheme, let them know what happened, tell them everything, 100% you'll be entitled to a claim, and they'll cover that up until £85,000.
That's really useful. Really useful to know.
And I suppose the key thing I want to say, that not only stretches towards loans, also stretches towards savings as well.
That's savings as well?
Yeah, stretches to savings as well. So that goes across all institutions, not only just Plain Saver, but most institutions. So that is one thing when you're looking to open savings accounts with banks or other institutions, or looking for lending products, that is definitely a compensation scheme to look out for, and see if they're regulated and protected by that. Because the last thing you'd want is to go through savings and loans, especially at a time like this, and if something was to happen and you weren't protected, that would cause a hell of a lot more stress and worry than needed to. So obviously do your due diligence, do your checks, and keep yourself protected. Your future self will thank your past self. So
it's really good to see that Plain Saver is part of the FSCS compensation scheme, and anyone, whether it is a saving account or a loan, that you make sure the institution you use is covered by that.
Absolutely.
Okay, so sort of final question from my end. One we haven't touched on so much is mortgages and car loans.
Yeah.
With all these loans, there's 0% interest loans sometimes in certain countries. In particular areas, there aren't this. But the bigger question is, are loans good or bad? What's the difference between good debt and bad debt?
Now, again, I think you probably saved the hardest question to last. Now, I think I'd probably say it's probably subjective.
Okay.
Depends on who you ask that question, but in my personal opinion, I would say loans are good. For reasons that I've probably already mentioned. Again, you can take your family away on holiday, you can buy yourself a car, you can make some home improvements that you've needed to do. If you need an emergency, you've got your savings there, you can apply for a loan, you can take out a loan to help you with said emergency. Now, I believe it all comes back down to financial education, and I think it comes down to a level of responsibility and how you want to use your finances. So again, like I said before, I think we spoke about debt consolidation heavily, and if you know that your finances are in a good state, then obviously again that's what the debt consolidation product is designed for, and you're looking to get yourself out of that debt consolidation cycle. You want to be financial free in instance. Now, I would say loans are good, but comes with an element of responsibility. If you know you're struggling with your finances, it wouldn't make sense for you to start borrowing even more to go towards, say, a holiday or home improvements or a vehicle, if you know that you're kind of living beyond your means. So I would say that's where the element of responsibility will play a good part in answering that question.
Yeah.
But I would say, if you ask me for my honest opinion, I would say loans are good. Loans are good.
Okay, so that's a nice way to end, actually. It's really interesting to see that even with things like the debt consolidation, it's important that you're able to afford it.
Yeah.
So you may be reducing someone's debt, but if they have even more that we haven't been able to support, then it's a conversation of how we can support them in other ways.
Exactly, and leading on to, like you said, about support, because that's what we're known for and that's what we want to do. One thing I'd probably say, again, I've mentioned the term misconception quite a few times, and when members have been declined, I've spoken to quite a few members, and again, I'd say to members that are watching this right now, feel free to give us a call if you've got any more questions regarding a current loan process that you're going through, or you're thinking about taking a loan. Feel free to give us a call, and we'll happily answer your questions. And the one thing I'd probably say is there's a nice website called Credit Karma. Now you can log on there and you can create an account, and what they'll do is you'll be able to see your credit profile for free. And then again, like I mentioned before, if you were declined for due to your credit profile, you can look on Credit Karma and see any indicators on your credit profile. And you think, right, I need to work on getting this cleared off, or if something doesn't look right, you can raise it with the credit reference agencies, and you can look to get that removed, and that would help build your credit profile. So that's something I would look at. And I said misconception. There's a common misconception between not just our members, but just people in general, that you need to have a good credit profile to be approved a loan. Again, this is probably a subjective and a biased answer, but I'd probably argue that you'd have to have your finances in check, probably just as important, if not more important, than your credit profile, to make sure that you can afford a loan. Now, I think we spoke about the process, but I don't think I actually, my apologies, quite went into depth of what's required through our process, or through any process through an institution. Now, the reason why I say that is not only will we look at a credit profile, the one thing we look at affordability, and to do that we'll ask for bank statements.
Okay.
And institutions will also look for bank statements. And with the growing reach of technology, instead of submitting paper statements, coming in to deliver them by hand or by post, you can now either email paper statements over to us, or PDF statements. But what most companies are doing now, they actually work with a nice handy tool called open banking. So again, providing you give us consent, same concept as giving consent to perform a credit check, or ask for your consent to view your transactions, and then we'll be able to do an affordability check on yourself. And then if your credit profile is obviously in good shape, but your finances may not be in great shape, if you can't afford the loan, then again, that will be another reason why you may be declined. So I'd say, yeah, credit profile and affordability, those two kind of go hand in hand in terms of important factors to determine the outcome of a loan decision.
Really like that. So it's almost what you touched on earlier about the budgeting element, and how budgeting is important, making sure you live within your means, making sure that you can afford the products that you potentially are taking out. So on that, I'd like to sort of say thank you for listening to the audience. I'd like to say thank you to you, James, for being able to give us a really nice brief and sort of an in-depth understanding of loans, different products, and the top tips on how to get better, or how to succeed, essentially. And it segues nicely onto next month's webinar. So next month in August, our webinar is on back to school budgets, budgeting. We will be joined by a financial coach who will help us understand the different tools and strategies to budget and help us save on school expenses. It's really important. So thank you again for listening. Please keep an eye out and a look in your emails. We'll let you know how to sign up for the upcoming webinar and tell you where you can rewatch them. Thank you.
Thank you very much.
Bye.